Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I am a financial advisor, but this video is not financial advice. It's for your education and your entertainment. If you get anything out of it, would love a like, a comment, a share. And on that note, thank you so much to the viewers. Thank you for the watch time. Over 7,000 hours this month of education that's going out there to you guys. Thank you to the subscribers, over 1,600 subs, and this channel's made over $200. I will get paid next month for the first time from YouTube, and 100% of the earnings from this channel go to GME DRS shares. So we get to build our own budget for life infinity pool together. Thank you for being a part of it. In this video, I want to talk about what is GameStop's fair value, and I want to start with the software business. If you've been on my GME sheet, which by the way, I should mention, thank you to those who join my channel as a fan or as a friend. Fourth, I wanted to pull that up for you, but maybe I don't know how to get to my videos that fourth. Here you go. Thank you to those that join. As a fan, you get extra perks, get discount off merch. Thank you to those that join as friends. I will share my GameStop spreadsheet with you. If you've been on it, then you know GameStop's valuation, it is an equation. It is their retail business, however you want to value that, plus their asset management business, however you want to value that, to get to what is their total fair value as a business. But here's the thing with GameStop, the retailer, there are three different businesses that they're engaged in. There's the hardware business, the software business, the collectibles business. Over my past few videos, I've been diving into the software business because, in my opinion, it is the least important, the least valuable of GameStop's businesses. And so I've wanted to value each of these businesses independently because they have very different cost structures, very different profit margins, very different bull and bear case scenarios, very different multiples you would give them. And together, eventually, we will be able to add up software, hardware, collectibles to give you our retail business valuation, and then asset management to give you our total fair value in three scenarios. You'll see this orange, yellow, green, the floor valuation, the fair valuation, and the fly valuation. These are not numbers that limit what they could be worth one day. Even in the fly situation, I'm not talking about this is the most that it could ever be worth. This is what I'm saying is this is the most that you could justify it being worth right now. I'm not talking about what could they be worth one day. I'm talking about right now. What is GameStop software business worth? Let's start with the floor, the worst case scenario. How would you value this software business? Well, if you look historically over the past several years, I've got their software dollar amount here in this kind of bottom row I've highlighted. You know, year over year from 21 to 22, it declined about 10%. The next year to 23, it declined about 20%. The next year to 24, it declined about 30%. And I would say so far in 2025, I'd say a decent guess for what this full year number will be for software will end up potentially around 800 billion, which would be another 20% drop. So the worst case scenario, realistically, is that GameStop never turns this business around. That the sector headwind related to software, which GameStop does make some of this money digitally, but a lot of their software business comes through hard copy video games and especially traded video games. And so let's just say it just keeps going down 20% year over year until extinction. There's no valuation indefinitely to software. Then basically the way you would value that business, and well, let's say like there's going to be some super niche market for software, like retro games will still exist. Okay, so maybe it wouldn't, even in a worst case scenario, a valuation of zero would maybe be a little bit extreme, but next to zero, what if it keeps going down 20% year over year until one day they make 50 million annually on software and that's it? Well, in that scenario, basically you would just value what is the cash generation that's going to come over the coming few years, and that gets you into margins because it's not just how much revenue does the software business generate, which we know 2025 is going to be about 800 million in revenue, but it's how much profit are they going to make on that revenue. And estimated software margins are around maybe 30-35%. So if they make 800 million in 2025, which I would say is kind of the floor scenario. Let's say they continue to decline at a 20% rate. You could get a little more aggressive. Say they continue to decline at a 25% rate. The reason I'm not going to say 30 is the worst is because their total sales also came down by 1.4 billion, by almost 20% year over year, or more than 20%. And a lot of that is due to GameStop shrinking its store count. So when you see these year over year dollar figure declines, not all of that is representative of the software business declining. A good portion of that is representative of GameStop shrinking its business. Back in 2018, their revenue was 8 billion, and in 2024, their revenue was 3.8 billion, right? So it's not realistic to say that, oh, software is just falling off a cliff, cratering, and now it's going to just become, minus 50% year over year. But I would say if you were very, very bearish, kind of floor price scenario of software, you'd say they're surely worth like basically the decline rate of software physical is maybe 25% year over year. In that case, that 750 mil that they will make this year, 30, let's say you don't think it's 35% margins, you think it's more like 30% margins. So 750 million in 2025, 30% margin, 25% decline year over year. So this year at 30%, they will make uh 225 mil in their software business on that if they make 750 million at a 30% margin. Sorry, that's not correct. Yeah, 225 million. Now, how much of the SG&A do you attribute to GameStop software business? Well, the best we have to go off of quarter two, the most recent quarter, is that software is 15% of the net sales. And if you think GameStop's software business is going to keep declining, then you might think that number would even get lower. But let's just say that they remain 15% of SG&A and that SG&A for the entire year looks like it's on pace to be a decent bit less than last year, no doubt. I mean, they're already saved about 100 million from last year. Let's say their SG&A ends up being 900 million for the year, which seems like maybe a little bit of a low estimate. But again, this is the floor case scenario. Well, what's 15% of 900 million? That would be 135 of SG&A costs coming out of that 225. So that would give you a $90 million cash flow in 2025 for their software business. So 90 million net. Oops. And then let's just say that declines until you end up at a 50 or maybe $100 million annualized revenue rate for their software business. So what does that do, right? In the next year, right, 750 million times 0.25 is 187 million of cash, right? It's like almost just take that net cash and it's like, okay, about 70 million in 26, and then you take another 75% of that, and then it's 50 million net in 27, and then you take another 25% of that, or sorry, 25% off. And so now you're basically at 35 million in 28, right? And what is the total revenue related to a $35 million net profit? We're probably about there already. Maybe one more year to 29 as far as because the percent of SG&A, if you have this floor price scenario with their software, like this 15% is going to get lower and lower and lower. So the SG&A cost that you attribute to the software business should also get lower and lower and lower. But basically you have, okay, for a few more years, you have a 90 million and then 70, 50, 35 million dollar cash flow. You add all those up to say, okay, 90 plus 70 plus 50 plus 35. So you have a $250 million business plus how you value kind of the perpetuity from there. And if you said it bottomed out at, say, $100 million of revenue, and then you said that they still clear the same margins on that and through their trade-in model, etc. So a huge shrinking, right? Almost 10% of the size of the software business of what it is today, right? This is a very bear case scenario, right? It's hard to imagine all of the retro games just poof evaporating. No one wants to play GameCube or Switch 2s or PS4s or Xbox. Like all the games just poof. Like that's not a realistic scenario. Realistically, in a worst case scenario, could the software business be 10% of what it is today? Maybe so. Maybe so. And so what do you value that um kind of that legacy business as? I'd say if you're clearing basically 30 million in profit or 25 million, so let's say the SG&A is 5% or takes another $5 million off. If you're clearing 25 million of profit annually, right? And then 25 million per year from there. At what PE? What PE would you give a stable business that makes $25 million a year? And it's like, well, you've got these other kind of struggling businesses that are at 16, at an 18. I mean, you could say should it be even lower than that? It's hard. Any legitimate business that's stable, it's hard to say, oh, it's going to be worth even less than a business that's struggling. And so if there's still a market for the software business, but let's just say let's just get really, really bearish and say you give it a 10 PE because everyone's still skeptical. No one thinks it's going to last, whatever. Then you have your cash flow over these next 4 years, right? 90 million plus 70 plus 50 plus 35. And then you have a $25 million a year cash flow after that at a 10 PE. You give it a 10 multiple, that's $250 million. And you end up at a $495 million valuation for just their software business in really the most bearish case possible. And if you wanted to, you could then, do a DCF and say, okay, well, if it's going to be worth 500 million in 5 years, then maybe we discount that and say it's only worth 385 in present years. You could pick whatever discount rate that you want to put on it. But realistically, this is about as bad as the software could get for now. These numbers could end up being worse, right? But it's hard to project, it's hard to justify this projecting that this business will become extinct because GameStop has told you that they care about this business. I made a video recently about why their software sales are not going away. Between GameStop's investment into this business, between what they're doing for their pros, between what they're doing to help their brand, between the ways that they're improving the quality of their stores, I think it is fair to project a scenario much better than what we just described in this floor situation. I also think that there is value to the ability to hold a game as far as the salvage value. You can resell it, whereas a digital game you can't. It's not server dependent. You can still play it. There and PSA is now grading games to where there's a chance they even become collectibles that this software business actually inverts one day. But to project even a worst case right now on the software business going extinct, I think is too far of a reach. But maybe 5 years from now, that wouldn't be a far reach. But from what we can see right now, there's no indication to think this business is going away. And GameStop's made it really clear that they want to continue this part of their business. And so, again, based on what we can see, really the lowest valuation that would be even possible for their software is about a $500 million valuation. A fair situation is to more honestly assess how much of this revenue decline in their software sales is related to the store closures, right? And secondly, how much of the sluggishness in this software decline is related to the console cycle. The last wave of consoles happened in basically 2019 and 2020, and it was not until this most recent quarter of 2025 that the Nintendo Switch 2 is available for sale. And then we have the Xbox handheld coming in Q4 or maybe 2026. And then we have the new Xbox console, new PlayStation console coming in 26 or 27, whatever it may be. And those new consoles come with new games, right? So, of course, software sales are going to bottom out almost kind of in line with the way that hardware sales bottoms out. And when you add on top of that, that you're going to have half as many stores as you had a few years ago, we see their store count 3,200 in 2024 when it was up at 5,800 in 2018 and estimated they're down to 2,200 at this point in 2025. So with a substantially smaller store footprint, of course, their total revenue for software came down, just like their total revenue for everything came down. And that is not a reason to project that the entire business is going to keep declining in revenue forever and ever. That's not a fair conclusion to make, particularly when it was a very clearly articulated from years prior plan to shrink the footprint and get more efficient and more profitable as a company. They told you they were going to surrender top line growth for several years to get right as a company. And they've told you now that they are prepared to begin scaling as a company. So, a fair situation for software, I don't think it's um, I don't think it's fair necessarily in a most level-headed way to take everything I just described and say that their software sales are going to explode or that GameStop will be able to invert the industry headwind that software faces. I don't think that's fair, but I do think it's fair to say that they will, um, through what they do as a brand, as a company, and through the intrinsic value that a physical game carries, and through the added dynamic of kind of the artwork, the nostalgia, the collector value officially coming into play in a way that it really never has before, not on the stage of PSA's brand. I think it is fair to say that they, in an effort as a whole company to return to sales growth, that basically it levels itself out. That the headwinds of software are met with the tailwinds of GameStop, and that software just holds its ground. Let's say it reverts a little bit for round numbers sake. Let's say they fight their way back to $1 billion annually in software sales. Whether that happen, they achieve that in 25, maybe 26, maybe 27, right? A whole new console cycle, whole new sets of games, right? In just the beginning of the collectibles, you could say that they hold, and let's say that they keep the same 800 million in 2025. It doesn't even really matter. 1 billion annually. And then what kind of growth do you put that? 0% growth year over year. Sorry for my crazy spelling. So just a 100% annual business without any growth at all. What type of margin do you, let's say they get the same 35% margin, or let's keep it at 30%. Maybe you think 35 is, for whatever reason, too bullish. Then you say, okay, at $1 billion, 30% margin, that means they make 700 million in profit every year. And if 15% of that is SG&A, then that means that they're netting 595 million a year, right? 595 million annual net SG&A. Now, what kind of multiple do you give a business that is legitimately steady? So this one we gave it a 10 PE because there was still a risk. What if somehow it shrinks even less than 10% of this, right? So we gave it a 10 PE. If you knew there's enough tailwinds behind GameStop to compete against the headwinds of the software industry, and maybe also you see some other players back out. Maybe the Walmarts, the Targets, the Best Buys, maybe they stop selling video games. Like GameStop will be the last one to go down. And if market share starts concentrating towards GameStop, again, to think that they would be able to hold their ground, right? Right now, they probably have what, 10% of the video game market, 15% of the physical game market. I mean, it's like, well, one day they might have 90% of the physical game market, right? So again, is it fair to say they could level out right at about where they're at right now? I think that's very fair. If they did and SG&A maintained the 15% uh, proportional weight that it is, um, then basically you have this $600 million business deciding on a price to earnings multiple for just a kind of flatline business, not a whole lot of excitement. I think a 22 is pretty fair, maybe even a little bit conservative. But if you put 22 PE on a $595 million cash flow, then you have a $1.3 billion valuation right now on just their software business. Right now, just their software business, which is by far the least valuable entity within their retail business, can account for more than 50% of the actual uh, market cap right now of their retailer. What the market is telling you their retailer is worth, you could justify very conservatively half of it from the worst part of their whole business. Now, let's say, what about a fly scenario? What about a fly scenario? This one is really tough to project right now because the only thing that could happen that would, like, the best case scenarios for GameStop, it's really coming down to how much does grading impact the video game market? Do people begin scooping up video games to get them graded, to play the game of infinite money and fun and joy as gamers and as enthusiasts? And we don't know that PSA just took over What A Games. We don't know how that's going to impact games. So I would say like one day, as you're putting together a fly valuation for software, it could be like very easy to project a better situation than what we can project right now. But I would say you're still starting at a billion as kind of like your base annual. But then what happens is you can say we have a third our 35% margin instead of 30%. And then you could say we're going to grow. It's not just going to be flat, but we're going to have some growth. Now, does it turn into like in the super bullish sense, like Pokemon cards, like you could say it's growing 100% year over year, but I don't think that's realistic. That's it could happen. One day you might be able to model that. Right now, it doesn't feel very fair. I know this is the fly situation, so but we still want to keep it realistic, right? In our floor situation, we're not saying like, well, what if someone nukes all video games and the warehouses and they all burn up and now they're never going to be made again? It's like, okay, can we just be realistic? Like the realistic fly situation, I still think the best you could imagine is like a 30% growth rate year over year to their software business. And this would require the collectible dynamic of software to make a huge impact. And it's honestly a little bit irresponsible to even put this on the fly valuation until we see it in the numbers. But it's not impossible to envision that. They've announced the partnership with PSA, and PSA has announced they're taking over grading. And we've seen what PSA's grading combined with just the present day of 2025 and the way people choose to spend their money, we've seen what that can do to the trading card market. So is it crazy to think that the software industry, like the video game industry, would have just a fraction of the type of momentum that a trading card industry has? I don't think it's irresponsible. I don't think it's unrealistic, even though it is a little irresponsible to put that in right now. If you can see how that could come to fruition within a couple year window, I think it's still being honest to say like, yeah, 30% year over year growth uh, is in the cards. And so that $1 billion annual revenue in that first year makes you whatever, $350 million, and then you take out whatever, the 10% or 15% for SG&A, it still gives you a $300 million cash flow. That can't be right. What did I do? I messed I messed up this one. I took out 30% instead of giving them. I should have taken out 70% up here, and instead I took out 30%. Right? Right. Regardless, let's go ahead and fix this real quick. If y'all hey, if y'all are here for the actual rationale, drop a like, drop a comment. If you're trying to learn how to think about GameStop valuations, let me know. But yeah, that $1 billion would not make them 700 million. It would make them 300 million, right? Which would be, almost three times what we're describing in this floor situation, and then declining from there. What we're saying is 300 million in this fair situation gives you a $255 million net, and then 255 times 22. Oh, so I messed up the PE too. So this is literally a 5 points. This got way better. $250 million net at a 22 PE. Let's say the 22 is still a little rich, because if it's not going to grow at all, I'd say that's maybe being a little bit too generous. Let's give it an 18. Now you're at a $4.6 billion valuation in a fair case situation for just their software business right now. Right now. If you want to be super fair, you could call this 800 million, and let's say this is the worst it gets and it never gets better from here, but it stays flat from here, right? 800 million annually and it stays flat. Let's get even more conservative with our fair situation. So now you're at 240 annual. Um, oh, and then you take 85 of that. So $204 million annually, net of the SG&A. You multiply that by 18, 3.7. Okay, so like, gosh, the retailer right now, right, if you net out the cash value of GameStop's market cap, that's basically what I'm approximating the market is valuing the retail business as. They're valuing the whole retail business, software plus hardware plus collectibles, which is booming in growth, at a 2.5 billion. And we're saying super fair case, super relaxed assumptions gives you a software business valuation of 3.7 billion. That's crazy. So, anyways, go into Fly. We say instead of bottoming at 800, they are able to tick back up to a billion. Instead of having 30% margin, they're able to command a 35% margin. Instead of being flat on growth, they're able to grow at a 30% rate year over year. But in that first year, right, that 100, that $1 billion times the 65%, no, times the 35%, they make 350 mil. You take out the SG&A, and you're at 298 mil net SG&A, and now you decide on a multiple. And if you are growing at 30% year over year in this fly situation for software, then you are going to command a premium in your PE. What exactly do you put the premium at? It's going to come down to how sustainable do you think that growth is. But again, in this fly situation, this growth is all related to the success of the collectible value for software. And so in this situation, it's hard to project why this earnings growth wouldn't continue because basically what you're saying is you own a commodity, like you own an appreciating asset. It's like saying why wouldn't the stock market continue to go up in value? It's like the collectible value is going to keep going up in value just for inflation's sake, if nothing else, right? But will it increase? Will it become even more valuable, right? Will it not just go up in a linear sense, but will it go like slope up in an exponential sense, right? Then it's like, who knows what kind of PE you want to get. But I think to be fair, I think people would still be skeptical even in this fly situation on is this just a fad? Is this going to crash? Will these things really hold value over time? I would say if it's growing 30% year over year, 4 years from now, we see that year over year. It's hard to say it wouldn't command at least a 30, if not a 35 PE. The S&P 500 average for a PE ratio is 33, and their average earnings growth is 10%. So honestly, I think if it's growing at 30%, even if people thought it was at risk of coming down, I have a hard time valuing it in this scenario at less than like a 45 PE. But let's just call it 40. 40 PE on the 298 gives you a $12 billion valuation or 11.9, or it's really 12 if you go 298. $12 billion valuation right now on just the software business. We're just talking the software business. That is crazy. So much upside. I'm excited to continue these valuation videos to add in hardware and collectibles and give you the worst realistic scenario for how you should value GameStop as a retailer right now, as well as the fair scenario for how you value them, as well as kind of the fly scenario of how you value them. And I'm excited to update these assumptions as we see the numbers come in quarter over quarter and as we see the stock move week after week to get an idea on how would you justify the market cap of the stock right now? How would you justify the share price right now? Should I sell? Should I sell? Is it getting overheated? Hopefully, these assumptions, these valuations can help you make the best decision for you to know if you feel like this upside that you're seeing on the stock in any particular given day or week, if it's something you feel the company can sustain, or if you feel like it's something that's pie in the sky. I'm going to try to bring level headed fundamental company analysis to try to help you make the best decisions for you. All I'd say, if you got anything out of this video, again, let me know. Anything else you want to add to the conversation on the valuation of the software business, would love to hear it. Would love to hear it. That's all I got for you on this one. Plenty more videos to come. So thank you for the viewers. Thank you, subscribers. Thanks for being a part of the story. All right. Talk to y'all soon.